Afternoon, everyone. Welcome to Chart This with Dave Keller. It's Tuesday, February 4th, 2025. I'm your host, Dave Keller, coming to you from a snowy and snow day ridden Redmond, Washington. All the schools are closed today in this area because we got about, 2 to 6 inches, depending on where you're at, which doesn't seem like much if you used to live in Boston, which I did, or in the east side of Cleveland, where you get that sort of snow, or the Buffalo area. But here in Seattle, Washington, a little bit of snow has some major havoc on the roads and a bunch of drivers not used to driving in icy conditions. So hope everyone here stays safe. We are sitting tight, recovering from the flu, staying out of the snow, and looking at some charts. Today, quite a day. I mean, and a nice upside follow-through day with the S&P sort of pushing back above 6,000. That's where we ended the day yesterday. Today, getting a bit of an upside follow-through already after the market close. Some news: Alphabet down big in the post-market. PayPal down pretty good today. A lot of charts to look at today as we review and reflect on the charts. And let's get to it here as we start our market recap. All right, major averages in the green today. The S&P 500 closing just below 60.38. That's up 0.7% from yesterday's close. The NASDAQ composite up 1.4%. Mid caps, small caps, all in the green as well. The small cap S&P 600 up 1.2%. NASDAQ 100 up 1.3%. The VIX drifting lower. We're back in this at a 17 handle. It's down about 1.5 from yesterday's close. So again, when I have a market that is in an uptrend, which I would argue this market still is, certainly on the medium term and long term time frame, our market trend model remains bullish on all time frames as of Friday. So in that environment, you look for signs that something's different. You look for signs that something is changing, and that goes from momentum and breadth divergences, which I think we've seen, but also goes to other signals that often coincide with major tops. And a spike in volatility is one of those telltale signs that things are starting to get uncomfortable. Not getting it today. Market moving higher today on lower volatility. That is a bull market configuration for sure. We'll keep going with interest rates, the other asset classes. We'll talk about sectors as well. As a reminder, I can't see questions that are coming in. We're live streaming on Facebook, LinkedIn, YouTube, and X. And I appreciate so much those of you tuning in live to the show. You can ask questions all during the show, anywhere where you can put a comment. I can see that through our live streaming platform. I'll take a question or two at the end of today's show. Anything we don't get to, we'll put in the final bar mailbag. Planning an old mailbag episode on Friday of this week. And we'd certainly love to answer one of your questions on the air. Some really good questions in last Friday's mailbag show. And if you missed that, some timeless comments, I think that hopefully you'll find interesting. All right, looking at the interest rate side of things in the fixed income markets, you can see that the yield curve generally drifting lower today, although the short end was a little bit higher. 10-year, 30-year, 5-year points all moving slightly lower. The 5-year points settling in just above 4.5%. It actually opened up a lot stronger. Bonds actually opened a little weaker, but traded higher through the course of the day. And that brings rates down, not quite to 4.5%, but heading in that direction. We'll show you the chart of the 10-year yield. I grabbed that for our chart review portion of the show today. Certainly rates have been coming down here in the last couple of weeks. I would argue that's still within an uptrend phase in rates. You'll see what I mean. We're actually right at the trend line using the major lows from August or September, wherever that last major low was on the 10-year yield. Dollar moving slightly lower. The UUP, which is a bullish dollar ETF, down about 0.9% today. Mixed results from the commodity space. You can see gold and silver both in the green. For the month of January, gold outperformed, and actually through today, year to date, gold has outperformed all the major equity averages and Bitcoin as well. That's the resilience that you see in that part of the market. Precious metals continuing to drive higher. Gold, from a technical perspective, gold probably a little more constructive than silver, but I would say both of those in primary uptrends here. The energy side of things a little weaker. You can see crude oil and natural gas ETFs were down, along with the gasoline ETF. Having said that, the energy sector ended up being the top performer today. Looking at the cryptocurrency space, you can see things deteriorating here in the last couple hours. Bitcoin's currently around 96,000. Yesterday, we talked about regaining that 100,000 level and how Bitcoin is a fairly constructive chart if that can be held. Didn't happen. To the contrary, we actually went back below 100K, sort of had these spurts pushing back above 100K, and now continuing to weaken. So, again, I think the short term Bitcoin is certainly not a fantastic chart. Look elsewhere. You can see Ethereum, Bitcoin Cash, Litecoin, Chainlink, a lot of these other top 10 coins on the stock charts platform down, in some cases double digits. Chainlink down 10% today. So you're definitely seeing a risk-off move in the crypto space. A bit disconnected from equities, right? So today you have equities finishing pretty strong. You have cryptocurrencies going a little weaker today, actually big time weaker today. So a bit of a divergence between two, generally highly correlated assets between stocks and cryptocurrencies. All right, looking at the 11 S&P sectors, you can see energy up 2.1%, technology up 1.4%, consumer discretionary up 1.2%. So we're back to some of the FANG sectors doing pretty well, but energy a surprising entry in the on the top of the leaderboard. The XLE was up 2.1%. Again, I still think energy is a tough sell from a technical perspective, or certainly from a macro perspective, until and unless crude oil prices improve more than they have so far, because energy stocks, it tends to be correlated to crude oil prices, particularly the relative strength. So if crude oil is going up, that's when energy starts to outperform. You're not really getting that today. The FANG sectors, again, showing quite a bit of strength here. Technology, number 2, and consumer discretionary communication services was number 4. 4 out of the 11 S&P sectors were in the red today. Utilities, down 0.9%. Consumer staples, down 0.8%. Healthcare, down 0.3%. And so what's interesting, excuse me, what's interesting here is consumer discretionary over consumer staples. Yesterday, staples outperformed. That was the first day in a long time that's happened. The general trend has been consumer discretionary or offense over consumer staples or defense. That's one of those main kind of risk on, risk off indicators that I look for. Earlier today, I cut the monthly chart review for my market misbehavior premium members. That's where we apply our market trend model to a bunch of different ETFs. That's where we look at some key ratios and performance statistics. One of the ratios we look at is offense over defense, and a number of other kind of risk on versus risk off ratios. Some of them not looking particularly good, like the relative strength of semiconductors has not been particularly strong in the last couple months. But one thing that has been consistently on the bullish side has been offense, consumer discretionary over defense, consumer staples. You had some earnings in the staple sector this week. They've not gone, generalizing, not gone particularly well. So I don't see that necessarily changing here. Looking quickly at the breadth, you can see about a 2-to-1 ratio in the NASDAQ of stocks up versus down. But look how that compares to the S&P 500. You've got a 50-50 split, a coin flip today as to whether S&P names were up or down. What's interesting is with the S&P, the breadth conditions have not been improving here recently, and we'll show you some charts looking at breadth conditions getting less ideal. The McClellan oscillator actually broke below the zero line yesterday. We'll see, given the strength that you saw today, I wouldn't be surprised if the McClellan oscillator popped back above the zero line today. That isn't probably updated on stock charts just yet. But that's one of those kind of red flags to look for as well. Short-term breadth indicators rotating negative can often be the sign at the beginning of a pullback phase. For now, worth noting that the breadth in the S&P weaker than in other areas of the market. As we highlighted on yesterday's show, our formal updating of our market trend model happens every Friday after the close. And as of last Friday, all of these were bullish across the board. But just in the first 2 trading sessions of February, you can see the short-term model may be turning negative, excuse me, across the board. We wouldn't update this until Friday at the close. And the short-term model turning negative isn't the end of the world. That happened 4 or 5 times through the course of 2024. And every one of those ended up resolving just fine to the upside. But major tops start with short-term pullbacks, right? All large losses begin as small losses, as I was taught. So looking for signs of deterioration in the short term, while it doesn't guarantee that that turns into a longer term pullback, it does tell me to start to look for signs of further deterioration. So for now, something we'll be monitoring certainly through the course of this week and into tomorrow. We'll look a little bit at the Magnificent Seven and friends here. Alphabet up 2.6% today, leading the way higher with this group of stocks. Alphabet reporting earnings after the close today, and not great. You're actually seeing the stock go down in the after hours. We'll look at the chart and also look at the after hours update. Tesla up 2.2%, Apple up 2.1%, Amazon about the same there. On the downside, Microsoft, the worst performer, still up. Boy, the chart of Microsoft is just not a great chart. One of my former analysts at Fidelity, Mark Dibble, I remember vividly looking at the chart of Microsoft, and he said in a meeting, this is one of those names that just doesn't chart well. And that was his way of describing just a name that doesn't trend, is just kind of this sloppy, mean reverting kind of mess. And that's what Microsoft has definitely been. I did a video earlier today on behavioral biases for Stock Charts TV. And one of the charts we looked at was Microsoft, because Microsoft has been flat in absolute terms. So it's actually been sideways for months and months, but the relative strength has been consistently lower, because this is a stock that's basically been sideways while most other things, including the benchmarks, have been going higher. So that's not a great look for sure. We'll dig into a couple of these as we get to the chart review portion of the show for sure. All right, let's look at the market carpet. This is a heat map style visualization. I love sort of the overall macro to micro analysis that you can do on a visualization like this. So what stands out? First thing that jumps off to me is the biggest names, particularly the biggest growth names, did quite well today. Generally speaking, Apple, Nvidia, Broadcom, Alphabet, Amazon, Tesla, all in the green, all up about 2+%. And that's a pretty good update. When that's happening, even if everything else is slightly lower, the major benchmarks are going to be up just because of the weight of those names. That's how skewed they are to the biggest names. So those doing quite well stands out to me. What also stands out to me is if you kind of mentally cover up the big green boxes, right? Cover up the mega cap names and kind of look at the rest of the day. Not great, right? And even though the S&P was kind of like a 50-50 day, it looks more negative than positive, certainly more neutral than positive, because I see a lot of things kind of that neutral amber color. On a day like this, by the way, it's important to note outliers. So I would look for things that do have different actions than the broader benchmark. So on a day like this, when the trend was positive, the benchmarks were up, look at the things that were actually down a bit. PayPal, probably the most concerning chart. I don't know if I grabbed PayPal, and I'm going to do it right now because I meant to. So we're going to do that right now. Let's see, PayPal, and we'll save it to the list. Meant to do this earlier. Sorry, guys. All right. So we put this here. We'll put it like there. All right. All right, going back to the heat map, PayPal's ones that I would grab. And so what I just did, I mean, honestly, this is what I love about the market carpet kind of visualization, right? You look at all of these things, you look for what's different, and I immediately am drawn to like PayPal, Synchrony Financial, Willis Towers Watson, Merck, Pepsi, and I immediately want to look at the charts, because the little preview chart's great, but you really want to look at the broader technical picture, look at some indicators and see where we're at relative to some key levels on here. So we'll look at PayPal in a little bit. I did not grab Merck, but I just want to show you that that's a stock that's obviously been in a period of deterioration for the last 6 to 8 months, from 130 down to below 100, and today kind of continuing to accelerate to the downside. That's an earnings name this week. Other things that stand out, energy in the green, which is kind of a bit of a head scratcher. I didn't really dig into the themes as to why energy was up today, but oil prices were a little bit lower. But Exxon, Chevron, both up almost 3% today. And you can see a lot of the other energy names in the S&P in the green as well. Certainly something to watch. I mean, energy has been a chronic underperformer relative to other areas of the market. We'll see if this is the beginning of something more constructive, but for now, questionable. All right, we'll get to the charts here. And I saw comments, and I appreciate the well wishes. Boy, my whole family. I mean, those of you that have kids that are all grown up, you may remember the school age kids thing where you all kind of pass a germ around and all watch each other get sick and then get healthy. We are doing that big time with flu at the moment in my house. I'm the big winner right now. And my son just hit a fever. So we'll keep taking it easy and Fingers crossed we all get through this okay. I hope we will, and I believe we will. All right, let's look at the major averages, the S&P 500, and then through some of the other charts here in our chart review portion of the day. So the S&P, I mean, honestly, choppy sideways, and that's sort of the general trend here. If you look at where we're at today, it's the exact same range we were first week in November, right? We had the spike higher after the elections. We traded higher for another couple days. We reached right around 6,000, and that's pretty much exactly where we were today. So the last 3 months have essentially gone nowhere. We've gone up to 6,100 plus. We've gone down to 5,800 minus, but at the end, we're right back at 6,000. A lot of times it can be really helpful to honestly just draw a horizontal line in the chart and see where we're at now and see what periods, when we've been at that same exact level, because that tells you that really from point A to point B, if we spend a lot of time there, it's just noise. So, you know, what the chart of the S&P, if you think about another way to think about it is, you had the big spike after the elections, and then there's this honeymoon week, right, where we gap higher, we close up at 6,000. But then for the last 3 months, the market's kind of been choppy, right? We've gone up a bit, we've gone down a bit, we've been mean reverting. We're in a sideways consolidation phase with 6,100 on the upper end. I'll call it 5,850 on the lower end, but we're not breaking out, and we're not directionally aggressive on either side. The RSI is dead even right around 50. So the markets, in terms of the equity markets as measured by the S&P 500, are neutral right now. And while technically, I mean, the long-term trend is still positive, in that the overall, vibe of the last year has been constructive, I would say in the medium-term time frame, we're sideways more than anything here. So, in this kind of environment, I think you patiently wait for a break above or below to get out of that consolidation phase that we've been in. Still too early to determine, most likely. I mentioned some of the breadth measures that have gotten less bullish here. Breadth is a concern generally when the markets are strong on weaker breadth. That's usually a negative sign. Two of the and actually the first two items on my market top checklist, and I know this because I was just sharing this with my market misbehavior premium members, kind of going through the 7 and updating on all of those. 2 of them deal with divergences, and one of them is breadth divergences. When the market's going higher on weaker breadth, it's usually a bit of a concern. You see that with the advanced decline lines that are all trending lower over the last 6 to 8 weeks. You can see that here, excuse me, with the McClellan oscillator rotating back below 0. Now, this is not updated for today's close just yet, given how on the New York Stock Exchange, the NYSE was up about a 2-to-1 ratio, advancers versus decliners. Would not be surprised if the McClellan oscillator went back above 0, but this is certainly something to watch, because the McClellan oscillator breaking below 0, while not always guaranteeing a downtrend phase, I mean, any major pullback it happens with the McClellan oscillator rotating below 0, most likely, because that tells you more things are going down than up, or at least the trend in advanced decline data is rotating more towards the decliners versus the advancers. So certainly something to watch, because that's been bullish since the second week in January, and just starting to pull off here. Also, we have less than 50% of the S&P members above their 50-day moving average. The S&P itself did hold its 50-day on a closing basis yesterday, and today remains above an upward sloping 50-day moving average, as you can see in the top panel. But toward the bottom, you can see that 60% of S&P members are above their 200-day moving average, and less than 50% are above their 50-day moving average. If that remains below 50, if the McClellan oscillator breaks below 0 and holds there, all that tells you is the chances of us just powering to new all-time highs on the S&P without some sort of pullback, the chances of that happening are very low. Certainly possible if the Magnificent Seven dominate and drag the benchmarks up with them. However, the breadth weakening to the degree that we're seeing is not good. And if you also just take a step back and look at October, November, December, January, every one of those months has seen a new all-time high for the S&P 500. Every one of those months has also seen a new low for the stocks above their 50-day moving average. So we're currently down around 50%. The last new high, which was pushing above 6,100 last week, we're around 60%. The previous time we made new highs, it's around 70%. Back here in September, it's around 82, 85%. So we're breaking, we're making new highs with less and less stocks regaining their 50-day moving averages on the upswings, and that is not a healthy environment. All right. Chaikin money flow. You can see this is one that actually is still quite strong. The Chaikin money flow is a volume-based indicator. Instead of looking at the daily volume readings, which you can do like this, right? This is looking at the daily volume on the SPY, and the bar just shows the volume, the number of shares traded on any given day. But the Chaikin money flow actually weights that daily volume reading based on where we close relative to the day's range. So if we close near the upper end of the range, that day's volume is considered bullish. If we close near the lower end of a day's range, that day's volume is considered quite bearish. And so it scales it based on the directional move in the day. So a big move on heavy volume has the biggest weight on the Chaikin money flow. It actually turned bullish the third week in January, remains bullish here in early February. So the volume is not really showing you're having a lot of distribution right now. Heavy volume on big down days would cause that indicator to turn back toward the zero line. And the signal you're looking for, number one, would be divergences, which we've highlighted a number of times here over the last couple of years. But then most meaningfully would be a break below the zero level. We got that last in mid-December, which was sort of this pullback phase. That's what I'd be looking for here. For now, the volume picture is quite constructive as measured by the Chaikin money flow. All right, let's look at interest rates. $TNX on the stock charts platform is 10-year treasury yields. A number of my podcast interviews over the last couple of weeks have involved interest rates. It's a standard question I ask people now because I think it's such an important investment theme. I just want to see what people are thinking about it. Last week, conversations with Peter Bookvar and Jay Hatfield both dealt with interest rates, particularly the conversation with Jay Hatfield. If you haven't listened to that yet, please do so, because he's a smart guy, and I got to ask him a lot of questions about different rates and the Fed and tax policy and all sorts of different macroeconomic points of view, how they relate to equities and other risk assets. So I think you'll enjoy that one very much. From a technical perspective, I would say coming off of the September 24 low, and you connect that to the late September, early October low, you can see that lines up pretty well with the low from early December. It lines up pretty well with the low from this week. So we have an uptrend channel of higher highs and higher lows. So I drew the bottom trend line, then made a parallel line just to show how the upper end of this channel is pretty symmetrical, right? Pretty consistent, kind of have a nice parallel trend channel where we trade between the upper and lower boundaries. So, basically we're testing the 50-day and testing the lower trend channel, which says to me we're most likely kind of rotating back higher and continuing this uptrend. We start breaking below that trend line support, breaking below the 50-day, which held in early December. I think that could be the beginning of something different for rates. For now, appears to be holding. All right, the chart of NVIDIA. We have NVIDIA and the SMH up here, just keeping these on here every day just to update day to day what's happening. What struck me of the chart of NVIDIA, we bounced yesterday and bounced today after Monday's gap lower, is just the general deterioration in NVIDIA. From here, where we're retesting the upper boundary of 150 to now where we're breaking below the 200-day moving average. And I feel like every day we remain below the 200-day just looks less and less like a constructive chart. And what's interesting with a chart like this is if you look at other charts like Meta, and again, I don't mean to keep throwing Meta around like it's the most perfect chart I've ever seen, but it is a chart just kind of going up, right? It's just kind of in an uptrend, making new highs, making higher lows on a pullback. And if you look at any of these different timeframes, just this nice constructive uptrend over the last 6 months. So anytime I just kind of throw Meta out there as an example, it's usually I'm just describing a good consistent uptrend. Palantir would be another one that kind of comes to mind. There are others as well. But again, when you look at a Meta and look at how that what makes that a strong chart, it's setting resistance levels and then breaking out. It's holding the 50-day or just spending a little bit of time below there on pullbacks, but overall, we're trading higher. The RSI rarely gets below 40. The relative strength is constructive, kind of checks all the boxes. None of those things that I just said are the case with NVIDIA. And so I think on a relative basis, if you compare the chart of NVIDIA versus other things, that's where it really looks kind of ugly. And so I'm happy kind of avoiding it NVIDIA until I see signs of accumulation. But one by one, it feels like the Magnificent Seven. I feel like there are less metas out there, and I feel like there are more NVIDIAs, more Teslas, more Apples, kind of rotating down in a position of weakness. For now, I think NVIDIA, as someone mentioned in the chat, a bit of a broken chart. Now, the SMH is not broken necessarily. I mean, it's not going up, but it's really not going down to any meaningful degree. I think what's different between the chart of NVIDIA, which is now broken down below a consolidation phase, semiconductors as a group are kind of holding in there. The SMH is below its 200-day moving average. That's not good, but it's still holding the 235 level, which is support that has held for the last 3 months. I think overall, it's still wait and see mode on a chart like this. I don't feel like strategists enough are neutral. I know that from going to Fidelity when neutral ratings were totally fine, because sometimes the chart just told you needed to wait. And I think that's one of those, right? This is one of those sit on your hands kind of charts. Just wait to see how it evolves. If I had a position in SMH, I'd probably hold on to it just in case it doesn't break down. But breaking below 235, I think that would be hard to justify from a technical perspective. If you get the ETF breaking below 235, which means we're undercutting this established support level, if the momentum declines with the RSI pushing below 30, in that case, or below 40, in that case, the relative strength continues to deteriorate. I think that's an ugly chart from a technical perspective. But for now, holding in there okay. So let's wait and see. Now, the problem with semiconductors is stocks like AMD are part of that group. Look at NVIDIA breaking down in the short term off of a consolidation phase. Look at semiconductors holding within a consolidation range. AMD is in a downtrend, and it's arguably in a downtrend for most of the last 12 months, right? Coming from early mid-May of last year. Excuse me, this is a stock that's been heading downwards. On a weekly chart, you can see the clear trend of lower highs and lower lows. On the daily chart, you get a bit of a different configuration, but certainly since October, this has been a clear downtrend phase. Below 2 downward sloping moving averages, the RSI is spending most of the time below 50, the relative strength deteriorating. AMD is just one of those names that I think is pretty rough. Now, this is reporting, AMD is reporting earnings today, so let's take a look at what's happening after hours. Down another 5.5%. So it's down, where are we at? Around 113. So it's kind of right around here right now, looking at the after hour session. But I mean, this is a chart going into earnings on a day like today. There's no way I would be holding a stock like this going into earnings, probably, unless I had some big fundamental thesis I'm thinking about. But from a technical perspective, I think this is a brutally negative chart, and especially at a time when other charts look constructive, right? That's the thing you have to remember. When you tie up your capital in something like an AMD, it's the opportunity cost of owning AMD. And if you remember your economics 101, by owning AMD, you miss out on the opportunity to own other things that are much better. So you are choosing to put your money in AMD instead of Meta. And as an AB, I don't know how you could justify that from a technical perspective. I'd much rather own the things that are going up, that are outperforming, that are having consistent uptrends. AMD certainly looks like with earnings today, it's not going to get it done. Alphabet, to be honest with you, one of the best Magnificent Seven charts going into today's close, up about 2.5%, closing above 200 a couple days ago. This was last week on Thursday, kind of closing above 200. Last couple days, kind of following through. Constructive pattern. I saw the headline that things were looking a little rough after hours. Excuse me. Yeah, we're down another 16 points in the after hour session, currently trading around 190. So we're actually back down here in the after hour session around the lower end of this range. What might happen is we draw kind of similar to NVIDIA and others, right? You kind of draw this sideways pattern. This is going to end up being a failed breakout above 200. We have to re-engage this, this consolidation range. Consider that a failed breakout. This is your new line in the sand. We break below 190 and break below the 50-day through the remainder of this week. All of a sudden, that goes from being a fantastic poster child of a bullish phase kind of chart to a broken chart. And again, what concerns me about this market is Apple is an exceptionally strong chart. until it isn't. Nvidia is an exceptionally strong chart. It looked like it was never going to go down until it started going down. Alphabet, now the latest one. Now, again, I mean, based on where it's trading after hours, it's not the end of the world yet. We'll see what happens tomorrow when we get back to the regular floor session. But overall, I'm concerned by what I saw in the after hours. PayPal, another one. PayPal is an interesting chart, I would say, because of the divergences that have been going into this week. If you cover up the last couple days here and just look at what's happened October, November, December, every one of those months saw a new all-time high or a new long-term high for PayPal, but on weaker momentum. The RSI has been steadily declining, and the most recent attempt to make a new high up to around 93, the RSI stalled out around 60. So you have that bearish divergence with the price going higher on weaker momentum. So today gapping down, kind of completing that dangerous combination of warning signs that we've observed here. Today's gap really takes us below that January low. And from a technical perspective, when you have something that gaps down like this, I immediately look to the left and see if buyers come in and sort of create support at a previous support level. So there's a scenario where the stock gaps down, opens at the January low, and a bunch of people are thrilled to get PayPal at a discount, $5 off coupon, and they buy a bunch of PayPal, and all of a sudden this is a gap that starts to trade higher. But the opposite happened. It gapped lower at the open, and no one came in to buy this. At the close, we're down at the lows of the day. And now we're actually testing the Halloween low from last year. So overall, I think that that was a chart that looked very strong in the third into the fourth quarter. Now, obviously, quite questionable with the gap lower today. Royal Caribbean is coming out with earnings. When was this? Oh, it was last week. Oh, I think it was just a good day for Royal Caribbean. Why did I grab this? It's a blur here. Let's see. Yeah, it's not nothing happening much on here. Maybe I was just highlighting this is a strong chart. It's interesting when you glance around, when you look around at all the different charts out there in the S&P 500. I'm struck by the fact that there are Royal Caribbeans out there that are just consistent uptrend phases, right? And again, what happens in this environment, more and more stocks are pulling a PayPal, great trends that all of a sudden look very ugly. So I'm happy remaining in names like this that work. And I would say that even if the major benchmarks rotate lower, even if our market trend model turns negative, if a Meta and a Royal Caribbean and a Palantir keep going up, if I own those names, I wouldn't sell them just because the market trend is changing. And I think that's maybe something that differentiates how I think of things versus some other strategists. And I know others would take more of a top-down approach. So if the conditions are bad, you kind of unwind risk, take risk off the table. I spent too much time with Peter Lynch-minded investors that they want to own good companies and good stories and good stocks. And if the stocks keep working, it doesn't matter what you think about the market, keep owning things that are going up. And that way of thinking stuck with me for sure. So for now, Royal Caribbean doing well, above 2 upward sloping moving averages. I feel like less and less stocks can be described that way, given what we're seeing here. I do want to highlight Electronic Arts. This is a stock reporting earnings today. This is a weekly chart of EA, and this is not a great chart. The daily chart obviously has been in a downtrend here for a little bit. We've had a bit of a bounce in January into early February, but overall, I think very much to prove here. The reason why I brought this up on the weekly chart is just to show how we're now at the lower end of this range here. We're kind of testing the lows from 2022 and 2023 and even late 2020 around 110. Excuse me. We're not quite down there, but if you have a contrarian hat, I could get the argument of, do we buy near some of those major lows going back there? But I would say on a daily chart, this is the problem. We've gapped lower, we've gapped higher again, but overall not really getting that upside follow through after the gap lower in mid-January. Let's look what happened on EA today. Whoops. Symbol summary, EA. Yeah, it's up a little bit after the market. Let's see, up to around 122.50. Yeah, so it's kind of right in the middle of the range today. So I get if you're a contrarian, you think, all right, I'm buying at the low end here. I would much rather wait for more signs of accumulation, wait for a higher low to emerge, which means, do we hold 115 on any kind of pullback? Those are the things I would look for. But with Electronic Arts looking like this, I'm happy looking elsewhere for good opportunities from a technical perspective. All right, last one. And then I'll take a question or two. Disney's actually reporting tomorrow, I think before the open, but I might be wrong on that. I think Disney is at a crucial technical juncture. One of the two things most likely happens here. I mean, if you look at the upside potential, this isn't a great cup and handle pattern. I won't claim that it is, because you have the high. This ideally would be more parallel with the previous high, but I would say breaking above that swing high from late November would be a pretty bullish development. On the downside, you've got a clear support level here around 106. So I think there's your framework, looking at the last couple months and just seeing where we get a break to the upside or the downside. If I don't own this name, I'm kind of waiting and seeing which way we go. I do, full disclosure, own Disney in a long-term account that I manage. But from a technical perspective, if you look, the gap higher in November was important, but then we stalled out above the previous high. We traded down basically to the gap, which now serves as support, and then we're breaking higher. And as a reminder, like with a chart like this, I often get asked about price gaps. I don't do anything crazy complicated. I just kind of usually draw this sort of thing here, like a range. I use the rectangle tool on stock charts and just kind of highlight the gap and just think about that range, because more often than not, a stock above the gap will find support when it pulls back, or if it's below, it'll find resistance when it trades up there. So keeping an eye on that gap range, I think, is pretty meaningful. So not surprised that we bounced off of that a couple weeks ago, and I would say you want to hold that on any sort of pullback. If we do get some sort of disappointment from earnings tomorrow, that's where I would be looking on the downside. And the upside, break to a new high above the November peak, and I think that's pretty constructive. All right. Let's look at some of the questions here that have come up. I was pretty active today looking at all of these comments on here, and I appreciate you so much putting them in here. Let's see. Charles, watching on YouTube, asks, Dave, if all these great charts, Alphabet, etc., look good one day, then tank the next day, so what predictive value does technical analysis offer? It's a fair question. I really appreciate you asking about that. Different things, right? So I would say with earnings, as much as Wall Street would suggest that they have a read on what's going to happen with earnings, if you look at the statistical analysis of or accuracy of earnings estimates, it's pretty bad, right? Analysts have to have a lot of time predicting how companies are going to earn going forward, and so I think it's implying that anyone has an idea what's going to happen with earnings is rough. Companies do things like forward-looking guidance and their whisper numbers and things like that. But at the end of the day, it's usually what I call a binary event, right? The stock can gap higher and gap lower. So what I would say is, for me, as a medium-term or long-term investor, I think you can hold stocks through earnings, because that's part of the story, right? Look at a Palantir for what happens when a company can continuously beat earnings and have that be a catalyst for long-term growth. And so I think that's the idea, right? If price follows earnings, which I think over the long term generally happens, looking for companies that are able to grow earnings over time is pretty good. And so each quarterly announcement is an incremental data point sort of telling that long-term story. Having said that, as a swing trader, I would definitely not be holding things through an earnings release just because things can gap higher or lower like that. That is a reality of investing in stocks. And if you want to own individual stocks, you have to accept the earnings risk that comes from that. I would say, while we can't necessarily predict what's going to happen with earnings, while we can't necessarily predict how much the market will react to earnings, although we can look at statistics and see how often or how much a stock tends to move around earnings. Again, anything can happen. What I would tell you is what happens the day or two after earnings can often be really, really valuable. And I think that's where charts can be incredibly meaningful. When a stock gaps because of earnings, it's not like a bunch of investors aren't looking at the charts. I think they are. And so recognizing key levels, recognizing things like the 200-day moving average, key support and resistance levels, and what the stock does when it gaps upwards or downwards relative to those those support and resistance levels, I think is pretty meaningful. That's how I would describe things for sure. Let's see, maybe take one more question here. Going through, let's see. I appreciate it. Right, I see at the end here. To respond to my earlier question, Bull Bear Jeff, thanks for watching. How long can the market ignore the instability of the U.S. government? We are undergoing a coup. Boy, this is a time for extreme political views, and I won't attempt to weigh in. One of my goals, being someone who talks about the markets all the time, and I have to talk about political issues because policy decisions have a very real impact on assets that we look at, and you can see that certainly this week with tariffs, with policy decisions and everything. My goal also, though, is that it's very unclear to all of you what my personal political views are, because I try desperately to not have that be part of my my discussion or my thinking. So if you're unclear as to how I'm voting on things, I consider that kind of a win. Having said that, I don't know if I would describe things as we're undergoing a coup. I would say there are definitely some significant changes. If you did not see that coming, I think you missed some clear writing on the wall in terms of what a Trump presidency would mean. We did a webcast before the November election results were announced, talk about the Trump portfolio, the Harris portfolio, and sort of an election-proof portfolio, I think I call it, things that would probably do well in both scenarios. But certainly the Trump portfolio involved, defense and higher investment in defense. Certainly brought in the possibility of tariffs, which again, as we've seen, tariffs are not being taken by the market particularly well, and not surprisingly, because they will most likely be inflationary and cause prices to go up for things like avocados or whiskey or whatever it is you want to get from some other place. But we'll have to see. What, generally speaking, and to answer your question, I guess, the as much as we're seeing a lot of movement, we have to remember that most of the things going on with the government are still quite stable. I think that's fair to say, although it certainly doesn't feel like that depending on who you ask. I would say most things are functioning pretty normally here. I would also say that policy decisions from the president are one thing among many that sort of weigh in on asset prices. I would not get too tied into one particular policy call or one particular thing that is announced, and remember that that's one thing among many that are going to cause things to fluctuate. And then the third thing I would say is that the market likes stability and it likes certainty. It does not like instability and uncertainty. And so I would say, particularly with tariffs, where we're announcing tariffs, we're taking them away, we're changing the timing and the amounts. That to me does not sound like a bullish scenario for stocks. So generally, I'm surprised the market has held up that well as it has, basically given the uncertainty of that. But I'll also go back to what I said at the very beginning of this episode, or the very beginning of the chart review. From the election gap higher and the week afterwards to get the S&P to 6,000, and where we are today, where the S&P was trading at 6,000, it's been a noisy sideways market, but we're no longer primarily going up. We're not primarily going down. We're in the middle. And I would say the market is telling you all that uncertainty about what's going on. I think the market is telling you it's uncertainty as well. It's uncertain as well, and still unclear as to what the potential impact will be. As always, we can watch the news and watch the announcements. At the end of the day, I would argue looking at the charts will help you navigate these things probably more than anything. Folks, thanks so much for the questions. I appreciate it very much. I appreciate you asking about charts among all sorts of other things. Anything I can do to help you navigate these markets, I'm certainly willing to do it. We've had a lot of great podcast interviews on my YouTube channel. You can get all of the podcasts. Last week, we had Jeff Hirsch, Peter Bookvar, Jay Hatfield. We have some other great guests lined up in the month of February. We're also on all the podcasting platforms now. So do me a favor and follow it on Spotify or Apple Podcasts, wherever you get it. For now, I'm Dave Keller with Market Misbehavior. Thanks so much for joining me on the show today. And remember, it's always a good time to own good charts. Have a good night, folks.